I'll remember this, I think, for the rest of my life because we had our first investor day on April 8th. And I think it was April 7th, Hong Kong market was down, yeah, it was down 11 or 12%. The
Hmm.
worst day since I think Tiananmen Square, or certainly the worst day this century. And so I was giving my is a 2 hour pitch to the investors. We had about 15 or 20 in Hong Kong in attendance. And I had my portfolio up on the background and I'm looking at it, it's 10 a.m. or whatever, and I'm doing my pitch and I can see the destruction, the pain, yet I'm still there to present, what happened the first year and the team developments and all that. And honestly, no one there asked me, how much exactly are we down? Everyone knew that we were down. So I'm appreciative to the investors who were in attendance who didn't, raise their hand at 10 a.m. and say, we're kind of curious, just how bad is it?
Hmm.
No one asked the question. And then, yeah, I was very happy at the end of that month to deliver a positive result.
What an incredible trust that we earn from the clients that we have when you really, really think about it. I think that's the biggest asset. It's not the assets under management. It's the fact that they'll stick with you and they'll trust you when they have all the reasons to question what's going on, isn't it? Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. You know how researching a company can take forever, digging through filings, transcripts, and reports trying to make sense of it all? That's where Tenzing comes in. It's an AI-powered market intelligence platform that helps you research public companies in minutes instead of days. Created by stock analysts for stock analysts, people who love the treasure hunt of investing. I spent over 20 years investing professionally, and when I started using Memo, it immediately became part of my process. It surfaced new ideas, helped me spot insights on stocks I held for years, and connected data points I'd completely missed. It's fast, intuitive, and gives you a research superpower. Tenzing sponsored this episode to help us make Talking Billions better for you. Use code BILLIONS at sign up for an extended trial and 10% off. Check out Tenzing Memo today. My guest today is Dan Rupp. He's the founder and chief investment officer of Parkway Capital. Dan brings a fascinating perspective to wealth creation, from Peace Corps volunteer to recognized expert in Asian value investing. Based in Hong Kong, he's developed the FARM approach for identifying undervalued compounders across Asian markets, taking a contrarian stance on China and Hong Kong when most investors are heading for the exits. Dan, how are you? So nice to see you.
Hi, great to be on.
Rick Carew, our mutual friend, connected us. Rick is teaching value investing at Fordham. He spent a lot of time in Asia. He was a guest on the show. In my mind, he has so much to offer and share on the world. of investing and Asia, especially. So, Rick, if you're blushing, we're talking about you. Then I want to jump right in. I have 1,000 questions and we have an hour. I want to start with the early days, childhood upbringing. How do you think that time shaped you?
Yeah, thanks. So I was brought up in Boone, North Carolina. It's in the mountains. It's a small college town. My father was a professor of English there. My mom was a stay-at-home mom. I'm the youngest of five, so I've got three brothers and a sister. And I had a great childhood. I mean, really, it was as you might expect in the mountains, is kind of a sporty youth. And with my brothers, we'd play tennis and ski. And in high school, I was a whitewater raft guide. So very kind of maybe atypical for finance. Money wasn't really the topic of conversation growing up. Um, but I think if I look at my dad, he was an academic. He wrote seven or eight books. Very bright. My mom, incredibly social, and she ended up when I went to school selling real estate. And I think she's almost 90. She's still selling houses in the high country. I think she was the highest producer or top three producer out of 200 a couple months ago in July. So she's got tons of energy. She's extroverted. So I probably have elements of both my mom and dad, but it was a great childhood.
It's a beautiful part of the country. So at some point, I spent a few months in the mountains of Georgia, just across the border from where you were. And we drove across to North Carolina. Beautiful part of the country. The mountains, it's green, it's lush, hiking trails. So a beautiful backdrop for growing up. And the two examples in the house, I think that shaped you in many different ways. I want to ask you.
I should jump in here
Yeah,
actually and just mention that Parkway, the name of my firm, is named after the Blue Ridge Parkway, and that's a road that goes from kind of southern North Carolina up towards Washington D.C., towards Charlottesville, Virginia. It's about a 500-mile road, and it's a national park. I think it was built during the Great Depression, part of the FDR's New Deal to get Americans back to work. But I kind of view what we're doing at Parkway as, it's a long, windy road. There's some ups and some downs. But if you like to drive and you like the outdoors, the Blue Ridge Parkway is a fantastic place to spend some time.
it's a beautiful part of the country and the world, which is a beautiful segue to the question that I have coming up. You have this idea that time in the market is more important than timing the market. And I think that's something that a lot of us forget. How does this belief, and you kind of describe it with the road trip, how does that belief shape your approach to building long-term wealth, especially in Asian equities?
Yeah, it's just I think when you're managing money and managing a portfolio, you want to minimize the decisions you make. And so, for example, we're long only, so we don't short, we don't hedge, and we stay fully invested. So we're trying to give our investors what we call Asia on the best terms possible. And so, I don't try to think, oh, maybe I should hold off and maybe the market's going to correct and I can redeploy later. I think it's easier to remove that decision making process and just say, look, we're going to stay fully invested throughout. And as money comes in, we deploy it. A great example of the importance of this just happened this year. I mean, in April with Liberation Day, um, we were at one point, down double digits for the month, and we basically had given back most of the gains in our first 15 months of operations, right? And if that had shaken, one's confidence, and if one had gone to cash, it'd be a very bad decision. And so, I think just knowing that markets go up, markets go down, generally over time, markets go up. It helped us kind of stay the course, and we actually ended that month positively. So quite a sharp correction, and it's been pretty much one direction, up and to the right ever since. But I think people who try to think they can, time the market, what it means is you think you know what's going to happen tomorrow, the next day, and frankly, I don't know that. So I think it's good just to remove decisions and just to focus on day in, day out, make sure that we have, the best equities we can for our investors.
I've been investing money for families for 20 years, and there are a few moments that I remember. And April of this year, we're talking in 2025, I'll remember for a while. But I also remember March of 2020 and March of 2009 and a few other moments. And I always wonder, how you and I, people that invest money for others, how do we add value? And there are 1,000 ways that we do. But I think one of them is that we can hold their hand for some tough times. And there will be times when you just want to get out. You just want to get out. And in March of 2020, fresh memory, I remember taking so many calls from both clients, but also fellow investors, friends in the business, private investors. I always make myself available, and people just emotionally couldn't take it. One person specifically told me he doesn't want to go through another '09, so he's going to get out here and just step aside. And it was probably, the most painful and, definitely financially uncomfortable decision with some, dire consequences for the following 12 months and the next few years. So anyways, I think those moments that you described, both getting in, but not getting out, that's where we can add a lot of value and just staying as hard as it seems at the moment.
We were, I'll remember this, I think, for the rest of my life because we had our first investor day on April 8th. And I think it was April 7th, Hong Kong market was down. Yeah, it was down 11 or 12%. The worst day since I think Tiananmen Square, or certainly the worst day this century. And so I was giving my is a 2 hour pitch to the investors. We had about 15 or 20 in Hong Kong in attendance, and I had my portfolio up on the background, and I'm looking at it. It's 10 a.m. or whatever, and I'm doing my pitch, and I can see the destruction, the pain. Yet I'm still there to present, what happened the first year and the team developments and all that. And honestly, no one there asked me, how much exactly are we down? Everyone knew that we were down. So I'm appreciative to the investors who were in attendance who didn't, raise their hand at 10 a.m. and say, we're kind of curious, just how bad is it? So no one asked the question. And then, I was very happy at the end of that month to deliver a positive result.
What an incredible trust that we earn from the clients that we have when you really, really think about it. I think that's the biggest asset. It's not the assets under management. It's the fact that they'll stick with you and they'll trust you when they have all the reasons to question what's going on, isn't it?
Well, I think they saw that, just finished my first year. Let's not put too much pressure on this guy. But even in the weeks, prior and after, nobody called to ask the number, like what's our month to date performance. No one asked that. So yeah, I think that's a good sign that we've got some patient investors, and I hope that we can give them a good result.
We could pull on this thread for a while. I'll just mention that, you could have the best, whatever that means, investment approach. But if the wrong clients find you, you're in trouble. Finding the right clients or the clients finding the right manager for what they're looking for, I think is key. And the range is big. It means different things to different people, but I think that alignment is key. I want to ask you about something that's at the center of your investment philosophy. You call it value with growth. And I recently wrote a piece. I called it more or less, cheap value worth paying for. And I think a lot of us get into value investing because we like cheap things. I think that's why we have any capital to start with, because we tend to be more frugal. And it takes us a while to appreciate that we have to pay up. But that's where the magic happens. How do you think of that value with growth approach that allows you to find compounders, sometimes trading at a discount?
Style buckets can be misleading, and I think value and quality mean different things to different people. But in my experience, for the last 20 years or so in Asia, I think for both portfolios, long only portfolios and single stocks, earnings growth is the most important determinant of returns. So I define value as paying as little as possible for this diversified stream of earnings growth. I think in the West, it's certainly true that to get reliable earnings growth, you have to pay a big premium. So I think that people equate quality with higher multiples. I think in Asia it's a little bit different. I think there are certainly there's more securities out here. I mean, my investable universe is over 11,000 stocks, and so I think with that sort of broad number of securities, I think you can find both quality, and to me, earnings growth is probably the most important part of quality, and you can get that at a fair price. So yeah, I think that's really the primary source of returns. There's a secondary source, which is dividend yield, and so dividend to us is effectively income that we reinvest into the fund, and we don't necessarily buy the same security which generated the dividend, but we look around and see what's most attractive when that cash comes in. So yeah, that's kind of the framework, and we're trying to. Um, we think that most of our returns will come from the earnings piece, so that's primary, and then dividend yields is a secondary source.
So I have to ask this about the universe that you're operating in, because in the US, but also I guess in Europe, but especially in the US, the number of listed companies actually came down over the years. And when you really go down the list, I mean, depending on your criteria, it's not 5,000, it's probably hundreds at best that I would consider. And if I'm really picky and I have friends that will invest only in 50 stocks that they've ever followed, that's also a choice. But you're talking about 11,000. Is it the number of countries you're looking at? Is it the fact that more companies are public, choose to be public? There's a huge appeal behind being a privately held company, especially with large family ownership, where you don't have to have outsiders looking in and asking questions and you can manage it the way you like it. Why is that? Why do you have such a huge universe?
Yeah, I think there hasn't really been as much consolidation and roll-ups in the public space in Asia as there has been in the US. Um, and there's lots of companies that probably shouldn't be listed, which are, if you do a bit of work, are pretty easy to rule out. So companies that really hoard cash and never return capital, and have super inefficient balance sheets. And this, what I mean, and this is just too much cash on balance sheets, which has been built up over generations. You have companies that exist to serve the needs of the second and third generations of the families who founded these companies, who don't have a whole lot of outside leadership. And so when you see those sorts of red flags, I tend to walk the other way or run the other way. Um, but no, there's lots. And Japan's got a lot of companies too. So I think given our mandate, it's 11 countries, but the deepest markets are Japan, and then secondly Hong Kong, China, with just a lot of securities. You also have this phenomena of kind of A and B shares in China. You've got common and preferred shares in Korea. So yeah, there are a lot of securities to sort through, but you, there's also securities that just don't trade very much, right? So once you put on some layers, some filters for size, for trading volume and whatnot, you can narrow things down. But yeah, there's a lot of things to look at out here.
Wish we had more listed stocks in America, in the US, and in Europe, by the way, but that's maybe one day. I want to ask you about something that I found fascinating reading your materials that you kindly shared with me. You talk about knowing what to ignore is half the battle. And I find it fascinating because when I got started 20 years ago, I thought I have to know it all. When people would ask me about a random stock, somehow because I work in the investment profession, I should have an opinion about that stock. And I should know why oil is up. And I should know why gold is down. And I should know where the rates are going. And then I realized not only I'll never know those things, but they don't really have much of a bearing on what I'm trying to do. Can you talk about which half we have to know and why it's half the battle here?
Well, one metric that really surprises me, actually shocks me, as I look at my benchmark, and it's a benchmark, it's a FTSE benchmark. It's called ACAP That's all country Asia Pac excluding India, Pakistan. So this is effectively from Japan down to Indonesia. The ROA on that benchmark is currently below 2%. And you think about an ROA of 2%. I mean, if you put your money in the bank, your ROA is more than 2%, right? And to get such a low return on your assets, it's a combination of bad quality businesses, um, cyclical businesses, loss-making businesses, right? It's actually quite hard, almost mathematically, to have such a poor return. Um, and for us, obviously, we have a ROA of multiples higher than that, but that just gives you a sense for how how easy it can be to ignore companies and industries and get to a more manageable number, right? So, what we avoid, um, we don't do much in financials. We don't do much with companies with excessive debt. In fact, the vast majority of our companies are net cash that we own. Um, we look for companies who have a history of returning capital. So yeah, you can narrow things down quite quickly. And obviously, we're going to ignore some great companies, and that's fine, right? Those are the errors of omission. Those are much less painful than the errors of commission. But that's what I mean by saying let's just focus on what we know is of reasonably high quality, and let's patiently buy companies when they trade, at fair values. So we go quickly from this 11,000 stock universe to what we call the farm of investable ideas. Call it a watch list if you want, or it's a subset of the universe. So that's about 120 companies currently, and that'll grow with time. And then the portfolio is a subset of that. But in the farm, there are these companies that we've identified as high quality, and we've got target prices. They're linked usually to like an EV/EBITDA multiple or a PE multiple or maybe a dividend yield for a defensive stock. And so we can quickly every week update the watch list and see what's traded close to our, you know, our. It's a target price, but it's not like a sell side target price. It's a target price at which we shouldn't lose too much money if we buy the stock. And so the idea is I've hired analysts, and I'm probably going to hire another one who can expand our circle of competence and help me kind of widen and broaden that farm to 150, 160 names. And we can just patiently wait for stocks and markets to kind of come towards us.
Related question to that I have to ask. I notice how in the last 20 years, the internet changed the game, the access to information. And obviously, it's all public, but I used to call in to listen to earnings calls, and I would put in my headphones, sit at a desk and listen. And now it's online. I can tune in. I can listen at any point. There are replays. There are transcripts. I can throw in a transcript, get it summarized. I can interact with the content in a completely different way. In Asia, are things online as much as they are in the US or even in Europe? Or is it something that you have to, go in and see for your your own benefit in person?
I think if you meet a company in person, after an earnings, after a quarter or something, and you can really ask them about it, you probably you're just more engaged. There's eye contact. You can read body language. I think it's still helpful to have the human interaction. The U.S. market does a great job of having these quarterly transcripts. So we do invest in some Chinese companies that are listed in the U.S. and so those ADRs, it's clockwork, right? You get the transcript, and sometimes the timing isn't great, and so I'll skip the live version of the call and read the transcript the next morning. But in the Asian markets, you don't get transcripts. It's not automatic. Some companies, the best ones, like a Tencent, they will give you the transcript, but most companies would not do that. I think earnings calls are open for the better companies. Will have an open earnings call and you get on a distribution list and email list. Not every company does that. So I think information doesn't quite flow as freely in Asia. But that being said, one thing that we're really keen on following is buybacks. Buybacks, I think, have better disclosure in Asia. So, in Hong Kong, for example, every day by say 7 p.m. or 8 p.m., there's a tab on the HK Exchange website where I can see exactly who bought back, what price, how many shares. So it's a daily feed. Same thing for Thailand, for Korea, for Indonesia. Whereas in the US, you have to wait till the end of a quarter, till the results announcement, and then you can figure out how much they bought. So some things are, you could say, better in Asia. But I think the earnings transcripts, I do see that in the US as being better disclosure.
Since you brought up buybacks, I have to ask, because on this show and in my life, I have a range of people Some believe in buybacks, some don't. It's extreme sometimes. How do you feel about buybacks? Good idea, bad idea? I'm sure there's some context where it could be a good idea.
This will surprise nobody who knows me even a little bit, but I love buybacks. I mean, uh, my wife, who's not in finance, hears me talking about buybacks. I think my 9 year old knows what a buyback is. My 5 year old, maybe not quite. Um, Now, buybacks, because there's good buybacks and bad buybacks, and I'm certainly not in the camp where all buybacks are good buybacks. But what people don't understand about Asia is we own we own a stock in Korea that we bought on 6 times earnings. Um, and so what is that, a 16% earnings yield? And they're committed to returning 70% of these earnings via dividends and buybacks. Well, my hurdle rate is 13%. And so assuming we don't get derated further from 6 times, it's a fairly safe way to make a double digit return, right? So anyhow, yeah, buybacks to me are best done. Ideally, the buybacks are with a company with a low PE that has excess cash on balance sheet and that is still generating more cash. And so when you convert that dollar into, taking away a dollar of shares, and I like companies who have a history, several years, 3 to 5 years plus, ideally, of doing this on a repeated basis. Because I think people look at charts sometimes, and you see a chart that goes sideways, and you say, okay, not much has happened. But if you see a chart that goes sideways and they've reduced share count by 30%, well, something has happened. The company's gotten 30% cheaper, and I think that's not appreciated by enough people. And so when I find a management team with a history of doing these buybacks and whose stock is cheap, and obviously fundamentally the business is still performing, and it's not a value trap or a falling knife. Yeah, I get really excited. I think right now, out of our 27 stocks, I think 16 are actively buying back.
Well, I really have to ask this. In the US, stock based compensation became a huge thing. All kinds of rules have changed over the last couple of decades, maybe 40 years. And some companies seem to issue a lot of those, and they do buybacks to offset it to an extent. These are different buybacks, and it's a different context that you're describing. Is stock based compensation a big thing in Asia?
The only stocks in our portfolio or that we look at, frankly, that do stock-based compensation are the Chinese ADRs who got advice from these American investment banks and listed in New York, and also those same companies. Some of them have different voting rights, for the founder. So again, taken some of these maybe not so good lessons from the U.S. markets. But in places like Thailand and Indonesia, and Korea, and in the non-tech shares, it's very rare to have that.
I like the idea of employees and executives being part owners, but how do we get there? I think it's a whole separate topic, and I don't know the formula that's been practiced by so many companies has really worked and built loyalty with the employee base, but that's a separate topic. I want to ask you about some of the categories that you invest in. You talk about compounders, defensive, and deep value. So you have a mix of things in your portfolio. How do you define them, and what's the optimal, allocation, or is it more driven by the opportunities that are in front of you?
Right. So we're trying to create a portfolio that has earnings growth, and obviously single stocks will disappoint with their earnings, uh, occasionally. But what we want is to deliver really double-digit earnings growth for the portfolio.
Hmm.
And so to get that, what we need is compounders. And so when we say compounders, obviously we're talking about long duration earnings growth of at least double digits. And so something like 70 to 80% of the portfolio is generally should be in these compounders. Um, and then we've got two other categories, defensive and deep value. Defensive stocks give us a couple of things. One is high dividend yields, and secondly, they should be lower beta. I guess part of that lower beta is, we can back test to see let's say that my benchmark goes back to 2006 or so. And so in those now almost 20 years, we look at the monthly data, say, let's look at the worst decile of months for the benchmark, right? So where maybe the benchmark is down 5% or worse. And then we can see what did the stocks do in those months? Did they outperform or not? So there's different ways to check your defensive ability or the amount of defense you get from a stock. But those are some of the things we look at when we analyze defensive stocks. And then the last one is deep value, and deep value is generally these are more balance sheet investments. So, we've owned net nets. You'd be surprised. People think that net nets, like Benjamin Graham investing, is dead. Maybe in America, but we there's probably hundreds of companies with if you take net current assets minus total liabilities is greater than market cap. So it's really an amazing fertile hunting ground. But between the deep value and the defensive companies, certainly deep value companies have a shorter holding period. So if you make 30 or 40% in a few months in deep value, I'm probably out. If I make 30% in a compounder, especially one that I bought after a big decline, I'm less likely to sell, or maybe I trim, but probably wouldn't sell out because you got to have some multi-baggers, on a 5-10 year view to really make the returns work.
Going back to your idea of fewer decisions, right? With compounders, if you buy them right and somehow you don't talk yourself out of owning it, it will do all the work for you. And I always say that the initial work, the research, the understanding of the business, the 90% of the effort. Yeah, then there's the ongoing maintenance, and it's not easy. But you've done the work, so let it fly. If anything that I've learned the last 20 years is very simple, letting winners fly and continue to perform. Don't cut them. And it's very hard. I know it's one of the hardest things, but I think there's a lot of money that gets left on the table because of it. Then I want to ask you about being bullish on China and Hong Kong. It looks like a lot of investors are not thinking about those markets, have left those markets, are running away, have some concerns, but you're seeing wealth building opportunities. What is the consensus missing when it comes to those markets?
Well, if I were speaking to an American audience or a Western audience, I would just warn people to be careful of extrapolation. So extrapolating the last 10 years to the next decade, both in the US and in Asia, is dangerous, right? I think that risk, you have to look at the valuations when you look at risk. So it's not as simple as saying, oh, I don't like this political system or that one, or words like this is uninvestable. Yeah, that sort of talk, I think you hear it less nowadays. I mean, obviously it's been a pretty good run for the last really since we started in Jan of 24. So I was more bullish on Hong Kong and China a year and a half ago because the markets were so beaten up. The Hang Seng index had halved between 2018 and 2024. The Hang Seng was down, I think, 5 years in a row, negative returns, until the year I launched, which was last year. So we started with Hong Kong and China as our biggest exposure, almost 50% of the portfolio, and now we've got it closer to 35%. So we've taken a little bit off the table and reallocated into places like Indonesia and Thailand, which have had relative weakness this year. But I'm still, China is the most important country in the region that we invest in. It's a mix of, we've got consumption plays, we got technology, we've got some global manufacturing. But I think what people miss is that, I think that if you look at our lifetimes, the day that you and I die, I think China is going to be a huge manufacturing powerhouse, and they're making increasingly higher quality goods. I was in Shenzhen last weekend for an investment conference, and I'm looking at in the shopping mall where we stayed in a hotel adjacent to the shopping mall, and they have like flying cars for sale in the shopping mall. I mean, it's really crazy. It's amazing what they can do, and I think that people should appreciate that. And I think 0% China or zero weighting Asia in your portfolio is just the wrong amount, right? So you can decide probably you shouldn't be 100% like I am Asia, but yeah, I think having some reasonable amount of exposure and also just being aware that US markets, the source of returns for the last 10, 15 years has been, a big chunk has been multiple expansion. You can't or you shouldn't really extrapolate that going forward.
It's it's fascinating, and when you start looking around the globe, what I've noticed is that your imagination expands. And one of the things I want to zoom in with you on is there's this saying, and I'm going to paraphrase that when the US sneezes, the emerging markets get a pneumonia. But so you could see it as bad news, but I think from your perspective and from what I was reading from your writing, you find those moments of uncertainty as a dislocation and an opportunity. Can you talk about that? And I you don't have to give specific examples, but this year, some parts of Southeast Asia, Thailand specifically, some places experience massive sell-offs from what I know, and you're much closer to it. But that should sound like an opportunity for somebody that knows what they want to buy and is at the right place at the right time. Those dislocations might be much more severe than in the US or even in Europe, where a 5% decline calls for massive headlines of the end of the world. In Asia, it could be a 20% sell-off, and it's a day like any other. Can you talk about that range and what do you do about it?
Well, first, yeah, you mentioned when the U.S. seizes, the rest of the world catches a cold, and yes, historically, when U.S. has large sell-offs, Asia and the rest of the global markets quickly follow. I think probably so. What I don't want to happen is U.S. markets collapsing by 40%. That's not good for anybody. I think one possibility, which would be a good outcome for Asia, would be instead of having equity markets fall on a nominal basis, it's really the currency falls. Because when the US dollar falls, places like Indonesia, Thailand, Philippines, Hong Kong, China even tend to do fairly well. And so I think what we've seen this year, I think last year US dollar was quite strong globally, but they've given a lot of those gains back this year. There was a period for the last couple of months, excuse me, when the US dollar kind of stabilized a bit, but I think with this upcoming potential rate cut, we're seeing another bout of dollar weakness. And so if the sell-off happens not at the equity level, but at the currency level, I think that's quite bullish for Asia. But yeah, in terms of one of the benefits of having a generalist mandate and having this 11 country mandate is that we can kind of dynamically shift the portfolio. And I don't mean sell everything in China and become a Thai fund or Indonesian fund, but just on the margins. So for example, Thailand is it's been a fairly fully valued market for the last decade or so. So, if you look at the demographics of Thailand, it's not that young of a place. So, and growth isn't fantastic. There's some political issues going on currently. But the stock, the market was one of the weakest markets in Asia this year. So we had zero exposure to Thailand up until about 3 months ago. And so the market was down 25% or so in the first half of 25. I had single stocks down 50%, over the last year or so, and maybe down 75% over the last three. And so certain stocks had been sold off quite sharply. And also, this is on some political uncertainty, but also the Thais like to use leverage in the market. So whenever you have people trading on margin, you can get some pretty sharp drawdowns. So anyway, yeah, we now have three stocks in Thailand, and it's obviously early days, but we're making some money so far on those. But I think it's nice to be able to kind of jump into markets where you've done the work and you've got your watch lists and these companies hit their target prices. And frankly, it shows my analysts that hey, we are going to act on the work you do. And I think that's gratifying to them to know that the prep work that they're doing is useful. We don't know exactly when, but it's great to have ideas ready to go and to deploy capital on really good terms.
Volatility creates opportunities, and I know it's not comfortable, especially if you're an existing holder of stocks of any kind. But it does create opportunities to either deploy extra capital to work or reshuffle the portfolio. So, I mean, I ask people, if you find a stock you like, just look at the price range for the last 12 months. And so many people are surprised that even the stocks that they think everybody knows about, they trade it in a very wide range. And I can only imagine that in Asia, that could be a wider range that any imagination would allow us to believe. I work with families, long-term patient capital, and I have this idea of an infinite investment horizon. I'm not the only one. Many people do. But then I run into something that challenges that, which is the fact that the change is the only constant. Actually, in part of my research, I was reading a book written by a family that has had money for hundreds of years. And the first sentence in the book that they give to the members of the family is, change is the only constant. And you have this saying of, this too will change, and the idea of impermanence. How do you embrace impermanence when you're thinking about making those decisions, long-term wealth creation?
Yeah, this reminds me, when I started the fund, an acquaintance of mine who's also a fund manager, he gave me this. I don't think it's gold, but it's a gold colored coin. And there's a smiley face on one side and there's a frown on the other. And both sides say, this too will change. And I think the point of that is, don't get too pleased with yourself in the good times and don't get too depressed in the bad times. And the good times can go on for longer than you think, so can the bad times. So it's just trying to keep an even temperament, even keel, no matter what the markets give you. I think, fortunately, I've got a great family, and I'm happy to go to work in the mornings, and I'm happy to go home at night. And I don't really bring it home. My kids don't really want to hear about the markets, right? So, um, and just keeping the same schedule, work out a bit in the mornings when I can, play some tennis here or there, and go home and have dinner with the family, whether the markets go up or down. I think that just kind of gets you in a routine where you can handle some volatility. And obviously the upside volatility is a bit more fun. Um, but you have to be able to stomach some downside as well, because you never quite know where the market's going to go tomorrow. So I think that helps. I mean, I also feel like in terms of temperament, I'm a pretty laid back person in some ways. Like I've got a low heart rate. I think I just don't get too flustered by things. And that's not to mean I don't take things seriously. I do, but I don't let things get to me, and I try to avoid stress. And really, when I look to hire somebody, I mean, the very first question I ask myself is, does this person add stress, or will this person add stress to my life or take stress away? And if I have any sense that that person may add stress to me, uh, it doesn't really matter what other qualities they have, but it's not going to work.
Same applies to stocks, even if it's the best idea, but I'm not going to be able to fall asleep holding it. That's a great test for me not to have it. Speaking of that, what stood out for me reading your writing is that you maintain negative net debt to equity ratio. Basically, you don't want to get in trouble on the leverage front. And I find it fascinating because a lot of people get into investing to make money, but I think you have to figure out first, what are the potential ways to lose money? And I have a list of things that get you in trouble, and high leverage is at the top. Questionable management is right together with that. And then I talk about secular decline, which is a trap for a lot of people. Anyways, talk to me about this idea of negative net debt to equity. Why does it matter to you?
That wasn't really the goal per se. I mean, but
Mm-hmm.
if I look at our 27 companies, I think 22 are net cash. So only five companies have net debt. But you're right. We don't use leverage. I don't use leverage in my personal life. I think leverage can get you in a lot of trouble. And I think that having leverage can lead to zeros, and hopefully we've got no zeros in the portfolio. Certainly we'll lose some money on some of these companies, and our hit rate right now is probably higher than I'd expect, but we're in a bull market, so that's the reason for that. But what I like about, we did some work on this. I've got a great quant analyst who did this, but basically figured out kind of the I think it's called the slugging percentage in hedge fund parlance, but it's it's like what you make when you're right versus what you lose when you're wrong. And I think that yeah, it's something like 3 or 4x more we're making on our winners than we're losing on our losers. So I think having companies without too much debt, having companies that are best in class industry leaders with good managements that pay dividends and that have a little bit of growth. I think that's and if you buy them, at fair value or on low multiples, yeah, probably downside is limited. So that's where we are today. I mean, I'm sure we'll make some mistakes, but hopefully the mistakes, first off, aren't in your top five, like aren't the heavily weighted stocks. And secondly, the mistakes we have, hopefully, they may hurt a bit, but they're not going to kill us.
I have a no zero policy. I am not going to buy any stock that I can imagine going to zero. Of course, that there are crazy things that can happen, but there are obvious things that can lead to a zero. Huge leverage, questionable management, secular decline. When I go back down the list, these are the ones, but especially leverage. You and I know that that's how you go bankrupt, basically. So, and zero, I think it's not just financially, but emotionally, psychologically a big issue. I'll mention briefly, I remember a senior manager at one of the firms where I work, he took me aside and he said, I had one client that was obsessed about one line on the statement. It was a stock that went to zero. When he saw that, one case study, he didn't want to know anything about all the other stocks. This was the one stock he wanted to know about. And I thought, you know what? What I'm taking away from this is I don't want to have a single line on any statement of any client that's zero. We might not make as much money as we thought. We might lose some money, but I don't want to have a zero. I think it frees up so much of my attention for all the things that can go well. And I'd rather put it over there than on the zero.
Yeah, I had another idea for the name of my fund, and I wanted to call it Ichiro Capital because, if you just hit singles, you can be a Hall of Famer. And really, it's that concept of single swings versus home run swings. We want some doubles, but I just want a lot of singles. And if we can do that, I think we're going to do just fine.
Dan, I want to ask you about something that a lot of people don't ask about, and I don't know why. When do you sell? Where a lot of people spend a lot of time on like, these are the things I want to buy, these are the things I have. At some point you have to sell, either to make room for something new, or you and I can get things wrong. When do you sell? What's your practice here?
So, yeah, we've got three reasons to sell. One is a thesis break. Secondly, if we have a better opportunity. And thirdly, if the stock reaches its fair value or full valuation. Of the three, the thesis break is probably the hardest because that's effectively saying we were wrong. Before we buy a stock, it's important to us that we have an investment thesis. And this is a one-page document. This is not a complicated document. In some ways, it's not easy to write, but every stock we buy generally has 3 to 5 reasons we're buying the company. So we list those reasons out. And then we, state our expected returns, and then we highlight some risks. That's about it, right? So now I think it's good to journalize that because it's hard to, you want to know what you're thinking before you buy the first share. Because one risk is you get this thesis drift or something else happens and you kind of, the reason you own it is not the reason you bought it, which is okay, but you then need to update your thesis and just write that out and discuss it and make sure that you want to re-underrate the stock for these new reasons. So we've sold stocks for thesis breaks, and when we do sell stocks, I keep a table of kind of why we sold them. There's no post-mortem, no need to. I mean, if there's lessons to be learned, we'll talk about it. So that can be painful. And generally when you sell for a thesis break, you're crystallizing losses, right? Typically when something breaks, you're gonna take your losses and move on. For the other two reasons to sell, better opportunities and a full valuation, these can be a slightly happier sells. Our target is 13%. So if we had a stock in July, it's an ADR. In Chinese ADRs, by the way, I like them. I like some of them. There's a lot of really deep discounted ADRs, but these are high beta stocks, and I wouldn't want to have too many ADRs because I think when you wake up in Asia and you check the overnight markets, you tend to see largest moves up and down. But we had an ADR that went up 80% in July, and it was a deep value. It was a net stock. We bought it for negative enterprise value. So obviously that was a sell because when a deep value stock moves that much, we don't need to stick around and wait and see what's going to happen the rest of the year or next year. So that's a fun sell because we can redeploy that capital into other ideas. And then better opportunities. A lot of investing to me is kind of an A/B test,
Yeah.
right? If we have a company in XYZ industry, and then we find another company in a similar industry, is this better than what we already have? And so I think that can lead to some good discussion in our weekly investment meetings. And those are always good meetings to take. And sometimes we can, look at an industry and where we own a stock and then do the industry analysis and realize there's a better stock in the same industry. So that's probably a clear sell.
This idea that I talk about quite a bit, that I want to be the least wrong. And I apply it to almost every approach, both from the portfolio management side and individual stocks. And one of the things that I do that has helped me, I don't know if it applies to you, maybe, is that I do things gradually. Unless it's a massive market correction, and I know I don't have a lot of time. But if I like a stock, I'm very willing to start small, and I leave myself a lot of room to buy. And if I've had something for a while, and let's assume it was a success, I also gradually leave. And I know that some people hold a single share to remind them of something. People have all kinds of funny practices. But anyways, the point is that I've seen so many times, and you talk about the thesis changing, which I think is crucial. Investing is such a nonlinear experience. It's not that, 2 + 2 = 4 and you got the answer right. Sometimes A plus B equals 1,000 more or 100 more than you thought. The businesses surprise us, obviously on the negative side, but also on the positive side. The positive side is so open-ended. So that's why I give myself a chance. Listen, I did the work. I've owned it for a while. It's made money for me. I don't have to leave the party all at once. Do you have some thoughts about it?
Yeah, well, actually, this may not be directly related to your comment, but I think it's an interesting story. So, the Philippines is a kind of a minor market for us, right? It's what is it, like a 400 billion dollar GDP economy, and the stock market is not that active. I mean, there's days when the market only trades 50 million US dollars a day for the entire market. So it's not a market that's really accessible for large funds. We're a small fund, so we can get into it. And last year, I ended up with 3 stocks from the Philippines, and 2 of them were mistakes, and 2 of them were effectively thesis breaks. And we ended up. It took us 6 months to sell one, and it took us about almost 15 months to sell the other, but eventually they proved to be mistakes. But the good news is the third stock is a winner, and it's I think it's one of the best ways to play the shift from traditional retail to modern retail throughout Southeast Asia. So anyhow, we took the sales, took our small losses from the first 2, and put a bit more into that first one. And now we've made way more money in that first one than we lost in the other 2 combined. And we have a top 5 stock. I think it's number 3 currently in the portfolio, in this Philippine retailer, right? So, selling can be therapeutic, and it can help you, put that money into better ideas, and that leads to a better overall outcome. So we got 2 out of 3 wrong, but we ended up, making money in the process. And I think that now our confidence level in that top 5 stock is quite high, and think this can be a very long-term hold for us.
Now that's a great example of balancing the 2 sides, getting something wrong, but then the winning idea, paying for it and allowing you to perform. You talk about, your business, Parkway, as a race, running a long race. And I think you mentioned that you're at the first mile marker. Can you talk about the long-term vision, how this patient discipline approach will compound wealth over the next decade, and what can listeners learn from this marathon mindset?
Yeah, so I had effectively a 17-year apprenticeship at one of the best funds in Asia. And to me, it would be a shame not to apply those lessons learned for less than 17 years, right? So if you learn a craft, and it takes a long time to learn the craft, don't you want to apply those lessons for a very long period of time? Investing, I think for those who are in it, it's a lot of work. It's 7 days a week. It's pretty fully immersive, but I also really enjoy it. And I do this for free. In fact, I did do it for free. I didn't pay myself for the first 2 years. And I was incredibly happy doing it. Right. So I think that the signals are out there that I can do this for a long time. It's one of the few things that you can get better at as you age, right? And so that's fun. Um, some people maybe get better at golf and they spend a lot of time doing it. Frankly, I like golf. My handicap's 30, so I'm obviously not playing that much of it. But and I also like to run, and I do these long distance races. So it's almost when I'm out there and I did a 100K race in over 3 days in Kazakhstan last year, and I'll do another 100K race in November in Nepal this year, assuming that the politics, hopefully there was some sort of riots, I think yesterday. But anyway,
It's a
yeah.
hilly
So
it's a hilly place. Nepal is a
yeah,
hilly place.
look, I've never won any race, right? And I probably never will, and that's fine. And my brothers are the same way. I mean, the Rupps aren't known for their speed, but we are pretty good at long distance, and we kind of grind it out. So anyway, as it relates to investing, yeah, I think of it. We had our first investor meeting after our first year in April, and we've kind of set the tone for how we're going to run this. And we've got we got a number of investors who I think are happy with what we've done so far, and I just like to do this for as many years as possible. I mean, really, the question is, I think it's how many doubles can you get in your lifetime, and obviously doubles are a combination of your performance and the time you've got, and yeah, steady performance for a long period can lead to hopefully a few doubles, and that's kind of that's the goal. It's really to deliver good outcomes to my investors and to myself, and just have a lot of fun in the process.
I love this metaphor and parallel between long distance running and investing, and this bigger idea that if you love something, if you love doing it, it's no longer work. I don't think somebody had this story that you can't fake that you enjoy wine and wine tasting. If you're not into wine, don't go to a wine tasting. And investing is very similar. Yes, you can make yourself be an analyst and work for a portfolio manager or manage money. You can force yourself to it. But somebody that loves it and will show up one more time, one more day, look at one more annual report because they love it, has such a huge quiet advantage over everybody else that's doing it just for the paycheck or the 9 to 5 or whatever it is that makes them do it. And I think people like you, I see myself the same way. I love it so much. I'll show up and have another conversation about buybacks and dividends and everything else. Not because somebody made me, but because I'm fascinated with the topic. Anyways, one last question for you, Dan. How do you think about success?
Yeah, so I actually mentioned this already. I mean, success to me, and I've heard your show. I love it. It's one of 10 or so podcasts that are kind of on repeat. And when I'm out on those runs on these beautiful trails in Hong Kong, I'm always listening to the podcast. And so I've heard this question before. And when I thought about how I'd answer this question, I may be copying one of your guests who's already said this. And if so, I apologize. But somebody said success is, getting up, being happy, being healthy, and going to work and enjoying that. And then also, finishing your work and going home and still being happy. And that's really, how we live our days is how we live our life. And I feel very blessed and just I'm grateful to those who've kind of put me in this position, my parents and my educators, and then my mentors at Overlook. But yeah, to be able to do what we're doing, and I travel quite a bit, which I love, and I meet interesting people and companies, um, you know, and I come back and see my family, and I've got a 9-month-old too, and she's gorgeous and fun, and she's crawling around now. It's everything is really great, and I feel like I'm just I'm doing what I was meant to be doing, so I think that is success, and I'm very grateful for everything that I've got.
Well, I love the sound of it. I think you're very lucky, and we're all very blessed that we found something we love doing. And I think it makes our outside of work life more complete and happy. If you're happy in one part, you're happy in the other one. But think about it, how much time we spend on our profession. Why would we spend it on something we don't like? To me, I miss the logic. I know you might have to do it for a few years at some point, but if you're going to do it over 50 years, find something that you really like. And I feel very fortunate that I found something and you did too.
Yeah, and I've got friends who retire in their early 50s, and they're quite keen to retire, right? And that's maybe a signal that they didn't really like what they were doing. But I guess the flip side of that is some of these people have found hobbies and interests and volunteer work and other things that they are passionate about, and so they get re-engaged, say in their 50s, and that's wonderful. But I'm just getting started, and I'm super excited and thrilled to be where in the seat I am, and I just hope more people can find work that they're passionate about, that they love, whatever that may be, because that's how you should spend your life, I think.
I love it. Dan, this was very special. I want to thank you again for this hour and staying up late for me and this audience. And Rick Carew, thank you again for making this happen, connecting us. And I recommend this audience to look up Rick's episode. We talk about Asia and the trade war and more. And I have not asked you about the trade war on purpose. Anyways, Dan, thank you so much for today. I really appreciate it.
Thank you. I enjoyed it.
Before we wrap up, a quick reminder, if you want to supercharge your investment research like I have, check out Hang Seng memo. Don't forget to use code BILLIONS at sign up for your extended trial and 10% discount. It's been a game changer for my process, and I think you'll find the same. Thanks for listening to Talking Billions, and I'll see you next time. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.